You're wondering when the Federal Reserve is going to lower rates. Are they going to keep rates the same? Are they going to raise rates? Is employment going higher or lower? Is inflation going higher and lower? And you just watched the recent FOMC statement this week and you're more confused than ever. Don't worry, I'm going to help you read between the lines because QE is coming faster than most people expect. My name is Joe Brown. I'm a former stockbroker. Now I run Heresy Financial, where I help active investors decrease portfolio risk, increase long-term returns. If that sounds like something you're interested in getting help with, go ahead and click on that link in the description below after the video. One of the ways that you can tell the direction the Federal Reserve is headed is by looking at the differences in their statement from one meeting to the next. And that's exactly what we're gonna do right now. All the text that you see in black is text that is the same or it is unchanged from the last FOMC meeting until this one. If you see text that has been crossed out, that is a word or phrase that was in the last statement but no longer appeared in the current one. And then if you see text in red that is not crossed out, that is text that appears in the new statement that did not appear in the last one. And see right off the bat, the word recent was replaced with, although swings in net exports have affected the data. It goes on to say that recent indicators suggest economic activity has continued to expand at a solid pace. What is going on here? They are referring to the recent contraction in GDP, the shrinking economy that was driven largely by the trade deficit. Q1 had a massive surge in imports as everybody was trying to front run tariffs. The Federal Reserve acknowledges that swings in net exports, in other words, a massive surge in imports causing a huge spike in the trade deficit, has happened, although economic activity has continued to expand at a solid pace. In other words, they're completely discounting the fact that GDP shrank because they're saying, well, it was largely due to front-running those tariffs. And that means that because you were front-running the tariffs, you're not going to be having that same level of importing in the following quarter because you've already bought that stuff that you need. And so imports are going to be offset next quarter from all of that front running. We essentially did 2 quarters worth of buying in the first quarter. Over the course of 2 quarters, or 3 quarters maybe, that's going to net itself out. So they're saying we're just discounting that. The next change in the statement comes in this sentence here. Uncertainty around the economic outlook has been replaced with uncertainty about the economic outlook. And they also said that it is increased further. These changes are small and irrelevant. Although the last sentence does matter. The last sentence in this paragraph is the committee is attentive to the risks to both sides of its dual mandate. Then it added this time and judges that the risks of higher employment and higher inflation have risen. Now, this is very important because for the Federal Reserve, employment and inflation are opposing goals. If they want to boost employment, the only tools that they have in their bucket are different ways to manipulate the money supply or to manipulate using the money supply. If they raise rates, they're trying to convince people to save and not spend and pay off their debt. If they lower rates, they're trying to convince people to borrow more and spend more and invest more. When they increase the size of their balance sheet, they're injecting a bunch of cash into the system, again, trying to spur that economic activity. When they reduce their balance sheet, they're sucking liquidity out of the financial system, again, trying to do the opposite. So all of their tools are there to manipulate the money supply. When they increase the money supply, that stimulates economic activity, which pushes up employment, and it also pushes up prices. When they shrink the money supply, that restricts economic activity, which pulls employment down and it pulls prices down. They are saying we have risks on both sides of the table here. It looks like the jobs environment is getting worse. We have risks for higher unemployment, but we also have risks for higher prices. So they're saying, hey, we're kind of stuck between a rock and a hard place right now, because if we ease, we're going to push prices up. But if we tighten, we're going to push unemployment up. So this is an important change. We'll come back to this later. Moving on, we can see nothing changed as they were talking about where they are keeping interest rates, saying that they're going to be carefully assessing incoming data. But they did eliminate this whole sentence here, which was basically their explanation of the fact that they decided to slow the pace of quantitative tightening. This is the Federal Reserve's balance sheet. This is where the assets that they buy go in times of QE. So like in 2020, when they bought a bunch of treasuries and mortgage-backed securities, they all went onto their balance sheet. And then starting in 2022, they slowly started letting some of that debt get paid off. And as that debt gets paid off, their balance sheet decreases in size. If we zoom in on just the last year, we can see that over the last month or so, the pace of this decline has slowed, which is exactly what they said they were going to do at their last meeting. They always do these transitions very slowly unless there is an absolute emergency. emergency. So over the last couple of years, they've been sucking liquidity out of the financial system with quantitative tightening, letting their balance sheet be reduced in size. But they're slowly bringing that to a close. So eventually here, within the next couple of months, their balance sheet will not be changing at all. So any debt that gets paid off, any of that debt that they own that gets paid off, they will just roll that straight back over. So their balance sheet will stay the exact same size. And then eventually that tips back over into QE and their balance sheet starts to head higher again. But I'm getting ahead of myself here. The rest of the statement has no changes, just saying that they are prepared to change their monetary policy stance if the data changes. And then we have some changes at the end about who voted. Now, why is it that I think that we are going to see a reduction in rates and a return to QE within the next 2 quarters? Well, mainly it's because of this right here. While the CPI still shows inflation at elevated levels, other, arguably more accurate measures of inflation currently show US inflation much lower. Now, this makes sense because when you have economic contraction, that is associated with falling prices. Also, tariffs. When you artificially, as a government, make some things more expensive, some things that people were already buying, that means that if they keep on buying those things and they spend more on those things, they have less money available for everything else. If they do decide to buy something else instead, it's something that they wouldn't have preferred to buy, either because of the quality or the price. In other words, overall, tariffs are not inflationary. They make some things more expensive, but they don't push the broad level of prices higher. In fact, because they are a depressive force on economic activity, they are actually deflationary overall. This data will show up in the official data at some point soon, whether it's in the next 3 months or 6 months, I don't know. But the Fed will no longer be between that rock and that hard place that we discussed earlier. They won't be sitting there trying to decide between making employment conditions worse or making price conditions worse. The price conditions, because of the depressed economic activity, because of the recession, because of the tariffs and the trade war, prices will already be lower anyway. They won't have to worry about triggering more inflation because that problem will have solved itself from the recession, which means they can focus on just dealing with the recession and the heightened unemployment by stimulating the economy. In other words, within the next couple of months, because of the economic pain, the Federal Reserve will allow themselves to return to QE and to cut rates because they won't have to be battling the inflation anymore. Over the long term, this means that the long-term debt cycle is still intact, that I've talked about many times on this channel. During this phase of the long-term debt cycle, we are seeing higher and higher interest rates, higher and higher inflation, while the government deleverages itself relative to the size of the economy. There are certain periods of time within this long-term debt cycle where interest rates and prices come down, but these are short-lived. It's actually probably what we are seeing right now and will last for maybe 1 or 2 more quarters. But 2020 marked the end of the last phase of the long-term debt cycle. It marked the end of lowering rates over time. It marked the end of the government levering up compared to the size of the economy over time. It marked the end of disinflation over time, which means we're not going to see 0% rates again. We're not going to see 2.5% mortgages again. We might see a brief reprieve here over the next couple of months, but over the long term, expect higher for longer. And if you'd like help applying ideas like this to your investing so you can protect yourself during times of crisis and overall grow your portfolio more long term, click on the link in the description below. As always, thanks so much for watching. Have a great day.